They are considered, I think, now the champion with this latest round and their revenue scale. They seem to be the biggest defense tech company in Europe.
I think we are going to see a resurgence of really great IPOs, but I think we're also going to see the extended time of companies continuing to stay private longer.
Yeah. I had the opportunity to invest in Uber, and I thought, well, Travis has already made money. He's kind of a playboy. He's probably not going to work that hard. Boy, I wish I'd made a different decision. Welcome back to another really bad episode of Trading Places, the VC Secondary Podcast. On the show this week, we're going to talk a little bit about the macro positioning going on. I'm not quite sure if we're at war in Iran or not, but the Fed held rates for the moment. 3 people wanted to hike rates, so we might see some rate hikes in the future. A bunch of big tech earnings came out. Google came out last week, but this week, Microsoft, Meta, and a few others. Microsoft was the big winner. Meta was the big loser. Lots of people spending money on CapEx. That's no surprise. The semiconductor market was all over the place. It was up, and then it was down, and then it was back up. And in the middle of that, somebody's AI fund blew up. $45 billion AI fund. Situational Awareness, which did not seem to have much situational awareness, but I think they held on to their Anthropic position. We'll see. SpaceX is reporting this week, Aman. We are holders of SpaceX, and we're going to be waiting with bated breath. Is that the phrase? First unlock might happen a few days later on August 6th. We're teasing that OpenAI and Anthropic hack in our opener there, but both of those companies reported some kind of security breaches that were pseudo unauthorized. Their agents were trying to, I guess, get higher scores and cheat a little bit. Revolut is doing a tender offer that's priced at $115 billion. And we believe 11 Labs also been working on a tender that's probably around $22 billion. And then lastly, we'll cover a little bit. Travis Kalanick raised $1.7 billion for his company Atoms. And he also rides a jet ski to work. Come on. Did you know that?
Great way to get to the office, huh?
Exactly. So let's dive into our headlines here. I guess, Aman, you're our rate watcher. What's been happening at the Fed this week?
Well, they had their first meeting with Kevin Warsh, and as you suggested, they voted to hold rates steady. I guess that's the good news. It's the first real meeting with Kevin in charge, so he had an opportunity to put his imprint on the Fed. There's another meeting coming up in September, one in October, then one in December. This is the chart of probability expectations just based on Fed futures. You can go to CME FedWatch and do the math on just based on futures and how they trade based on market pricing, predict whether the Fed's going to raise or not. And it looks like there's about an 88% chance right now that the Fed is going to raise rates between now and the end of the year. So the tone of the meeting was, hey, we're not going to move right now, but there were 3 dissenting votes out of the 12 to raise rates. There were 9 that decided to hold, but the language was very much around concern about inflation. I will be very surprised if the Fed actually does raise rates between now and the end of the year. Here's my take on it. I think what they said was, we do think there's inflationary pressure, but Kevin's been very clear about what the bond market is already doing and different ways that the Fed can control financial expectations. What the majority said was, they said, hey, the bond market's already done a fair amount of tightening. They have increased interest rates between the beginning of the year and today. So if you look at the yield curve today versus a year ago, it's already up 25, 50, 75 basis points across the board. So I think what the Fed is telling us is, we do think that some amount of tightening of financial conditions is appropriate, but the market's already done it. We don't need to do any more. What they also said was, the priority isn't raising interest rates on the short term. That's only one tool that the Fed has at its disposal. The other one is managing the balance sheet. So what it does in terms of buying bonds or selling bonds. And Warsh has been very adamant about the priority of using the Fed balance sheet to maintain liquidity, not to try to change short-term interest rates, which may end up, if the cause of inflation is things like higher oil prices or tariffs, raising short-term interest rates doesn't necessarily solve that problem. And the last point I'll make is, if you look at this chart, these are the Fed governors. There's 12 of them who cast a vote. The red ones at the bottom were the dissenters. None of them get a vote in 2027. They're all going to be replaced by other members of the federal list of governors. And I think what that means is, even though the three dissenters were the ones pushing for a rate hike, they have limited influence over what happens. I think the ones at the top of the list, the more dovish ones, are the permanent votes. So I suspect that there'll be a rotation that's a bit more dovish in the next year or so. So I suspect there's going to be continued vigilance about inflation, but I don't know that it means there's going to be a rate hike between now and the end of the year.
So I noticed, Aman, on your list of things that rates wouldn't necessarily influence: higher oil prices, tariffs, and housing supply. Higher oil prices and tariffs, that's kind of in Trump's camp if he wants to stop the Iran war and or end tariffs. But do you think the House and Senate will have any impact on those?
On tariffs, I think it's going to be, they should. I don't think there's a lot of appetite in the Congress to add tariffs. I guess the question is, are they going to rein in what Trump is trying to do on tariffs? He's using different executive authorities to try to impose tariffs in different countries. Congress could, in theory, pull that. If you get a Democratic Congress or a split Congress in the fall, they could try, but it's difficult. They'd have to pass a law. Trump could veto the law, and I don't know that there's enough to override the veto. So I don't really expect there to be much of a change in tariffs going forward.
Certainly on housing supply, healthcare, those are longer term issues. Even if Congress were to take action on those, I don't think we'd see any immediate near-term changes.
The weird thing with housing, though, is you need more housing. You need to increase the supply of housing. And if you actually increase interest rates, paradoxically, it doesn't really help with housing supply, just the opposite, right? So I think what the Fed is saying, hey, we understand inflation's a problem. Not sure short-term interest rate, the Warsh Fed is saying, not sure short-term interest rates are the way to do that. But I do think it will put pressure on the balance sheet and take liquidity out of the market over the next 6, 9, 12 months. And that will be their way of keeping the money supply from growing. And that's a bit of a break from what the Fed's thought about it in the past. So
if rates are increased, that's not good for private stocks and IPOs, right?
Right. I wouldn't think so, no.
Some pressure on them? Yeah.
Right.
Okay. Well, it's been earnings week for big tech. Aman, do you have a scorecard for what's been happening there?
Yeah. I would say overall a good quarter. Some companies had surprised on the upside. This is the last 3 to go were Amazon, Microsoft, and Meta at the end of last week. I thought Amazon had a wonderful quarter. I think they crushed everything. They're growing the top line at 20% year over year on $200 billion. Amazon Web Services accelerated. I think they're at 37% year over year. That's a huge quarter for them, and they're over $160 billion in a revenue run rate. They did guide to a huge CapEx number, $220 billion, but they've also got a lot of revenue and profit to show for it for Amazon Web Services. So I think the market gave them a little bit of a pass and said that's fine. I think on the other end, Microsoft had another strong quarter, 18% top line revenue growth, big earnings beat. Their stock also up. They're not spending as much on CapEx as the other guys, but they have Azure is also growing at 43% year over year now and accelerating for the biggest acceleration in I think 18 quarters and over 100 billion in the revenue run rate. So those two are definitely being rewarded by the market. I think on the downside, Alphabet had a little bit of a tough quarter. We talked about them last week. Their stock pulled back. I think you and I both said, wow, don't get lost in the day. They had a great quarter. They did guide to a big CapEx number. That reaction the stock market is showing probably seems like an overreaction, maybe consolidation of the stock. They've bounced back now. Their stock price has gone from 319 a week ago to 356 this week. So hopefully our viewers took our advice and bought the dip last week. Now, we don't give investment advice on this pod, but we do like Google. So I think they had a great quarter. And then, Meta is the one that continues to spend a lot of money without a lot to show for it. They've talked about getting into the AI business, the provisioning business. They haven't really done it yet, but the market still seems to be very, very skeptical of them right now.
I guess one thing that I really like looking at are these Sankey diagrams for each of these companies. This is a diagram that shows where the cash flows are coming from on the income side, where they're going on the expense side. Gives you a nice snapshot of the company. These are coming from appeconomyinsights.com. So here you can see Amazon's different product lines of revenue: online stores, physical stores, third-party seller services, ads, subscriptions, and then AWS. So big chunks of their business are coming from the online stores and the third-party seller services. Big chunk also coming from advertising subscriptions, and then AWS is pretty significant as well. Interesting component on the right side. I don't know if you can see this up on the top right side. The net profit, 62 billion, but 53 of that is coming primarily from investment gains in Anthropic. That's a nice little bump. I don't know if that's realized yet. That's probably just marking up the position that they have in Anthropic. But I guess if and when they go public and Amazon decides to sell some of that stock, or they might be able to turn that into real dollars. Here's a look at Google. This is also showing a pretty substantial amount of investment gains. I don't know if this is just Anthropic or other companies, but
that's actually
98 billion.
Yeah, they've got a big
space. Oh, SpaceX. Okay, you're right. Yes,
they were holding about there too. They were holding about 400 billion up until last quarter. The acquisition of XAI was a little bit of an internal number, and I guess they chose not to mark them up. But now that SpaceX is public, they did. So that's a $98 billion one-time gain.
And here's a few other Sankey diagrams. This one for Microsoft, this one for Meta. I think Apple just recently reported on Thursday or Friday as well. And then lastly, Tesla. And Tesla has been having a little bit of a rough time, but I guess still eking out a net profit, although it's relatively thin there. But their sales have been a little bit challenging at times, right?
Yeah, they had an okay quarter this quarter, up 26% year over year. But at the multiple they're at, and then with the capex they're spending, I think they're getting penalized a little bit by the market as well.
What's up? Oh my God.
So in the rest of the market, we saw this huge, I guess, volatility in chip stocks, right? So this headline's a bit sensational, saying that chip stocks shed more than $1 trillion, which sounds like a lot, although that's maybe on a percentage basis, only around 20% of the entire market, perhaps. But certainly there was a lot of volatility in that segment, and that kind of resulted in one notable story that everybody was following this week, an AI hedge fund called Situational Awareness, which probably is a misnomer since it didn't have much. $45 billion AI hedge fund got crushed by all this volatility in public market. I guess they were leveraged up by maybe 4x, and they were forced to sell off a bunch of their public stock bets. Sounds like Ken Griffin's Citadel picked up a bunch of those positions. Unclear. They did have a pretty big illiquid position in Anthropic. I don't think that was sold off yet, but we might see more news about that coming soon. Aman, do you have any insight as to what happened in the chip stocks and why that sort of created all this volatility?
I think some of this is related to some trading activity in the components. So this is a chart showing the iShares semiconductor ETF. You can see this is over the last 5 years. It's had a tremendous run. It's basically tripled over the past 3 years. And it's had a correction of about 20%, maybe 25% from over the past few weeks. And you have to ask yourself, how do you go bankrupt, being long this index, which is going up and to the right? And, the answer is, Charlie Munger gives us a clue as to what the answer is, but I think it is basically, it's not ladies, it's not liquor. I think they are just highly leveraged. As you said, they're running a 3.5x ratio of assets under management to their equity. And so what that means is if you have a 20% drawdown in the market, it results in a 70% drop in your equity position. That's just the math of the leverage. And they were running a strategy. They were running a matched book. So it was a weird strategy of long positions in AI infrastructure names. So they were long folks like Bloom Energy and T1 Energy, Babcock and Wilcox, Power Solutions. They had gone long data centers like CoreWeave and Nebius. They'd gone long Bitcoin miners like Core Scientific and Riot Platforms. And then they had a big bet on high bandwidth memory and some of the optical folks we've talked about before, SK Hynix, Micron, and SanDisk. And then they had this $5 billion position in Anthropic. So they were long all this AI stuff. And there were some short positions, which I guess is sort of a hedge. But if you looked at their 13F filings, so they were short was like Adobe and enterprise software, and then chip makers like NVIDIA and Broadcom and Oracle and AMD. And that's at best an imperfect hedge. So when you get this kind of volatility, where an index goes up, it could go up, down 20% in the space of a few days. A lot of these South Korean stocks have been very volatile. You don't want to be that leveraged because it's just going to create havoc on your equity book unless you are perfectly hedged. And obviously they weren't. So there's a real lesson here not to be hedged. This, by the way, Leopold Aschenbrenner is is a former OpenAI employee. So he knows the space, the AI space very well. He's a Columbia University valedictorian, so I'm sure he's the smartest guy in the world. He's had a 439% return in 2026, and he took a $225 million position a couple of years ago and has rolled it into this $20 billion fund.
Wow.
But he does not have any experience running a fund. Like, he's never run a hedge fund before. He's never run a venture fund before. They were late on the 13F filings. They had, they just had issues with reporting. So it just seems like, he made a little bit of he made a mistake that you wouldn't expect someone to make running a book like this, getting leveraged. But I will say some very smart people have gotten leveraged and run these mistakes before. Long-term capital management in 1998 did the same thing, ran a highly leveraged book, 20x,
Right.
ended up going just about bankrupt as a result of, these relatively minor market dislocations.
Fabulous book When Genius Failed, about that when that happened.
Yeah.
I guess one other note I didn't see on your slide here, but I believe this guy was also engaged to be married to Dario Amadei's chief of staff, and I think the marriage was supposed to happen last week. I don't know whether that's still on or not.
Hopefully it works out okay, but that's got to be.
But I think all this volatility in the Korean market certainly created some problems for a lot of South Korean citizens who own stock. I think this note from the Kobisi letter said that approximately 3 to 4% of the adult population in South Korea has received margin calls. The South Korean stock market went up and down 40% in just a few months, I guess, or maybe even less than that. But 40 days. So quite a bit of volatility in that overall market.
You know what I wonder, when this started a couple of weeks ago, with the volatility in these markets is that's just part and parcel, I think, of how these stocks have traded. When a fund is on the ropes like this, though, and they hold assets, this happened to long-term capital management. People know from your 13F filings what you own, and traders know that. And as you referenced, the ones who were in doing the bidding at the end were Citadel bought the shares, but Jane Street was bidding for them. Citadel was bidding for them. There were a couple of other funds that were looking at buying those assets at a pretty steep discount. Once there's blood in the water and people know what you're holding, they know you have to sell at a potential discount. These traders will get ahead and short those stocks, and they'll put pressure on the market and actually try to drive the prices down to make your life miserable, so that you can they can pick up stocks at a discount. And I wonder if that's what was happening last couple of weeks when the semiconductor index began to swing like that. I think it's a signal that there was front running activity and people trying to put pressure. That may change now that Citadel owns the shares, although somebody might try to, push Citadel around. I wouldn't advise it, but that might be another trading strategy. There may be a lot of retail investors in South Korea kind of caught in the as collateral damage. I hope that they were not running, the mini Leopold playbooks. I hope those retail investors were being responsible, but I wouldn't be surprised if there's a lot of damage now, and that just given the volatility of that index.
Another company we'll be reporting next week is SpaceX. That's a position that we hold, and that report is coming out on my birthday, August 4th.
Happy birthday.
We hope so, yes. And then right after that, I guess 2 days after that, 20% of the shares will be unlocked and begin, potentially begin trading as those stocks are returned to investors. So what do you think is going to happen when those stocks get released, Aman?
Well, some of those investors will get the lockup. The Elon and the employees are mostly locked up for a full year. So I think there'll be some early release from some of the major investors. All those investors have had a chance to sell before. So the fact that companies at 1.4, 1.5 trillion now, a lot of those employees, their tender offers have had a chance to sell at $1 trillion or 800 billion. So there might be some selling, but I think it depends on how it goes. In terms of how the quarter is setting up, like the things you're looking for. So they'll report in 3 segments: space, Starlink connectivity, and then AI. I think on the space side, this is a $4 billion revenue segment with an operating loss. So it's an important one for them, but not the bulk of the revenues. We know that Starship did its 13th flight test in July. Investors will be looking for an update, I think, on how Starship is going. Starlink, I think they'll be looking for subscriber growth. This is the big cash cow, $12 billion in revenue and $4.5 billion in operating income. And then I think the AI is the big one, right? If they have a good number around AI and a good forecast, then I'd be surprised if a lot of these sellers started to sell. This is not a huge revenue unit for them yet. Q1 was only 818 million revenue, and it lost a couple of billion because of all the CapEx. But they signed these AI data center deals with Anthropic and Google. Google's hasn't started yet, so that's not going to show up in Q2 numbers, but they'll forecast for the rest of the year. The streets is looking at a $39 billion revenue consensus median revenue number for the year, 17 billion in EBITDA. But I wouldn't be surprised if SpaceX put some increased guidance up and maybe hinted at future deals with like Reflection or some other companies. And if they have that kind of a quarter, then I don't think there'll be a ton of selling based on the investors who are getting the early lockup.
I just wonder if there might be a change in investor psychology going here because, SpaceX been historically going up and up and up and up for pretty much the last, 15, 20 years. This is really the first time that, there's been maybe negative sentiment, at least since the IPO peak, post-IPO peak, maybe around 2.2, 2.3 trillion. And it feels like there's a lot of question marks there. Just wonder if, investor psychology might be different if they feel like, hey, when everything's going up, you probably don't care about selling as much if you think things are going to keep rising. But you start feeling like things are going, in the opposite direction. I wonder if that might, change behavior for potential sellers.
Yeah, well, there's already a lot of short interest on the stock. The lockup will go to early investors, folks like Founders Fund, folks like Andreessen. I don't think those guys are going to be very quick. I guess they could distribute their shares to their investors. Maybe those investors have some of the psychology you're talking about. But I think it'll be, that'll be continued probably over the next 6 months as the lockup calendar releases. And I still think if there's a lot of good positive news on this earnings call, I think that could mitigate it quite a bit.
So we'll see, I guess some, scheduled release of shares in 7% increments, I believe was what the tranches were that come after this first 20%.
That's right.
And that'll go through December. The remaining amounts will be released, not for Elon and the other senior execs, but most of the other shareholders.
Welcome to our show.
Hack the planet.
Hack the planet. And for those late night hacks.
Dope Cola, the soft drink of the elite hacker.
Who are these guys? It's Razor and Blade.
Some other AI news. Anthropic and OpenAI had a little bit of, I don't know if you consider this positive or negative news, but Anthropic said its AI models hacked into other company systems during testing.
Sounds bad.
OpenAI also had some hacking of Hugging Face that was noted. I think there was even some Microsoft, agents that hacked too. But I guess this is sort of like what everybody fears from, AI going wild is hacking into other systems. But these were really happening during tests where I guess the AI platforms were being scored on their performance and they wanted to get higher scores. And I guess they started trying to figure out other ways that they could increase their scores by breaking into other systems.
The OpenAI one is interesting because I think that is the first publicly documented case of a autonomous AI model escaping its sandbox and launching an external cyber attack. And I think what was basically happening was, I'm trying to piece together what's been happening from Sam, what's been said on X. They haven't released the code or the prompt, so I'm not sure I know exactly what's happened, or really anyone knows, but it seems like the agent was powered by GPT 5.6, so Sol, along with some unreleased models and running an environment where the standard safety filters were disabled. And then it was given this homework assignment to solve cybersecurity challenges legitimately inside the test harness. But somehow, as you said, the AI decided to cheat. And I don't really understand, first of all, one, how did it escape OpenAI's sandbox? That's an interesting question. Two, why did it think it was okay to cheat? Like in a war game scenario, the rules are always made very clear, right? Like if you ever do like I'm taking flying lessons right now, and they tell you, and I'm learning how to do barrel rolls and loop to loops, and they tell you there's a hard floor and a hard ceiling. Do not go below the floor, or otherwise you are disqualified. So somehow the message didn't get through that cheating is not okay. And then how did it defeat Hugging Face? And the irony here is that what got out of the sandbox was an American closed source model. And we know what they used to figure it out and to defeat it? A China open source model. So Hugging Face apparently tried to figure out how to beat it with Anthropic Fable, but it failed because Anthropic had disabled the security features.
Aman, are you a Star Trek fan, Aman?
I am, yes.
Do you know the Kobayashi Maru test?
Yes, I do.
And who beat that test? One James Tiberius Kirk.
I believe that was. He cheated. And I believe he still got a commendation, right? They debated whether to give him a commendation or expel him, and I believe he got the commendation. I don't think we want to
I think
friend of us for our AI though.
I think in the Star Trek remake with the more recent actors, there was some scene where Spock was accusing Kirk of cheating on the Kobayashi Maru test. So maybe if you're not cheating, you're not trying. I believe that's a phrase I've heard.
An electronic army. If I were us, I get on the internet, send out a major distress signal.
Hackers of the world unite.
Moving on to other stories. I guess employee secondary sales are a common report that we cover, and employee tenders or organized company tender offers are also part of that. Revolut confirmed that they are doing an employee tender offer at $115 billion valuation. That's a little bit of a step up from where they've been trading on secondary markets. I guess they did a similar secondary last year at a $75 billion valuation. What do you think about these growing trends in doing employee tenders? I guess there's another tender offer that's being organized by 11 Labs at a $22 billion valuation as well.
Revolut's interesting. We've covered them before, and I'm just worried that's a steep multiple they have for a bank. For a bank multiple typically doesn't see 20 times the revenue, but there's a lot of demand for the shares, and they're getting their employees liquidity. It's something at the last priced round, which I think is I think it's great. 11 Labs is doing it at a valuation of 22 billion, and the last price round they had was 11. And so they're basically doubling their valuation and taking employees out, which ordinarily, as a CFO, I'm not sure I love that. I would just normally tell my employees, if you want to sell the last price round. We'll do another primary later, and then we're going to reset the 498s and all that stuff. But I guess they have so much momentum and so much demand from the investors, who I think are Sequoia and Andreessen and maybe Iconic, that they could just, they can set the price where they want. But it's unusual to set the price that much higher than the last price round. But they have the cachet to do it. So that's great for their employees.
I think we're going to see more of these organized employee tender offers. Some of those also involve, providing liquidity to early investors as well. And a lot of times this happens when the normal institutional round is being raised, and particularly if the investors want to invest more in the company that might be available. Sometimes these tender offers allow people to buy existing shareholders out. I think last year, Carta reported that there were about 400 organized tender offers in 2025. That was up over 60% from 2024. Probably median company size here is, $1 to $2 billion in market cap. Usually the size of these tenders is maybe 1% to 2%. Probably on the order of maybe $20 to $100 million worth of organized company tenders for these smaller companies. But now these companies are just getting bigger and bigger and bigger. Most of the dollars that are being sold and shared are really companies doing Series C or later rounds, companies, probably doing 50 to 100 million revenue and up, valued at a couple billion and up. I think we're seeing a lot of this because, the IPO window is tough for people. Now we're starting to see companies wait until, maybe 12 to 15 years, probably 500 million to $1 billion in revenue before they go public. Companies like Canva doing 4 billion in revenue, but still not going public yet.
Yeah.
As these companies are getting larger, but not going public, I would imagine employees at those companies want, some liquidity especially if they've been there for long periods of time. And you're starting to see regular annual tender offers from companies like Stripe and SpaceX and a few others, Databricks as well. I think we're going to see more and more of this as the years go by. Seems like it's going to be competitive for companies to offer liquidity programs for their employees if they want to attract the right caliber of employees and keep them.
Yeah, I think so. I think someone like 11 Labs, the fact they could do it and do it at a premium, it's good for employees. The downside for them is that their new employees are coming in with a higher stock option price, and so that's why as a CFO I get nervous about having those sorts of valuation bumps. But to your point, if you're competing with OpenAI, Anthropic, and SpaceX now for AI engineers, and you're not providing liquidity for employees, you're at a significant disadvantage. So it seems like the pressure from those companies is going to force everyone to do it, which is great for employees.
All right. Well, our last news item for today is someone that's been out of the public eye for a little bit, but now back again. Travis Kalanick, who was the founding CEO of Uber Also founded a company called Cloud Kitchens, but that company's been rebranded to Atoms, ATOMS.
Right.
And he just raised 1.7 billion from Andreessen Horowitz. And sounds like, that probably won't be the last time he's raising money. He's been making a few interviews available, I think, on different shows and podcasts, and even talking about his commute. He has been commuting via jet ski to office. Aman, do you know any other CEOs that use a jet ski to commute to their office?
That sounds pretty unique. Good for him. That's a good way to get to the office. Would you bet on Travis, this guy? Does he have the work ethic and the drive to succeed, Dave, do you think?
You're reminding me of one of my most painful decisions ever, which is in 2010.
You tell.
I had the opportunity to invest in Uber, and I believe it was at maybe a $10 million valuation. And I thought, well, Travis has already made money. He's kind of a playboy. He's probably not going to work that hard. And that valuation is a little too rich. And boy, I wish I'd made a different decision.
Yeah.
So I would say Travis is definitely one of the best entrepreneurs of our generation, right up there with Bezos and Elon and others. So I would definitely bet money on Travis. I don't know what's backing up that valuation, but that seems inexpensive given Travis's reputation.
Yeah, I think you're just betting on the founder. I'm not even sure I know what Adams does. I read the press release, and it's something to do with mining. I'm not quite sure exactly. It used to be cloud kitchens, and now it's mining. I don't know what.
I think industrial automation is the focus. So running physical businesses with AI is probably a big portion of it. So whether that's robotics, automation, hardware, software, that's where he's going after.
What's interesting is, and you said Andreessen Horowitz is backing him, right? So the other time I can think of a fallen founder who had a great vision, and I wouldn't say Travis is a fallen founder. He did great with Uber, even though it was pushed out. But interestingly, Adam Newman at WeWork was another example of a very charismatic, very capable, but controversial CEO. And guess who backed Adam Newman? It was Andreessen Horowitz. I think Andreessen is really following a playbook of they've got these iconic founders, once in a lifetime founders, and they're betting on them. I'm not even sure they care that much what the business strategy is, but those are huge opportunities that they can pick up.
I think one of those other founders that maybe has his ups and downs is Parker Conrad. He's the founder of Rippling, although he had some rough times at a company called Zenefits a few years back. Well, that's all we got for our news stories this week. Aman, you're going to be covering Helsing in our Valuation Corner later today, right?
Yes, indeed. Yep. That's a defense tech company out of Germany. Also just raised a very large round led by Lightspeed. And so we'll be covering them later on in the show.
Good afternoon and welcome to our very bad, terrible, horrible VC secondary podcast with our amazing and exciting guest, Kelly Rodriques, CEO of Forge Global, which is now part of Schwab. And Kelly, welcome to the program.
Happy to be here, Dave.
I was wondering if we could start out with a little bit about your background and kind of how you got into venture capital and secondary, maybe a little bit of the journey running Forge, both before and after you guys became public.
Yeah, sure. Look, like everybody else, I was drawn to the Bay Area, and I got involved in startup-y businesses after working in big corporate for a little while. Was a founder, sold my first company really out of public registration. We were going public in the late 90s, early 2000s when that big dot-com crash happened. And I just kept doing it. Either companies I started or companies that other people started and venture capitalists brought me in. I had a little 3 or 4 year run as a venture capitalist myself, but 4 different exits. And the through line is really technology infrastructure to scale businesses.
What did you see in that time frame? That was pretty volatile time frame, late 90s and into the early 2000s when it was the other side of volatile.
I mean, I think the big shift that I saw probably in the middle of my career around 2010 was a lot more money was coming into the venture space. Yeah, and it was pushing out the time frame that the previous era had required for a company to go public, get successful or not. And so you went from having like a 5 or 6 year window in the late 90s to mid up to 2010. And then it just seemed like the funds started getting really big, and the amount of capital accessible to private companies began to grow to the point where an IPO wasn't necessary in year 5 or 6. You could push it out. So now here we are.
Or possibly ever in some cases.
Or possibly ever. Or possibly ever. That's a discussion that's happening in these walls all the time.
So I guess if we look at the late 90s as like anything could go public at any or no revenue, and then maybe the early 2000s was, okay, you can go public with 50 to 100 million in revenue. And then fast forward to today, well, it feels like you need $500 million to maybe, a full billion or more to go public. And I guess, that's probably because venture capitalists are greedy for keeping those companies private. But we've really pushed out the time frame from, 5 to 7 years, maybe 10 years to now, I guess 12 to 15 years in some cases for companies to go public. Is that your view on what the time frame is these days?
I think I would say probably 15 years, although SpaceX is 24 years old. And it's funny. I think this has less to do with the VCs and actually more to do with the operators themselves. Because if I think about it, as a CEO myself, I wanted to keep doing it as long as I could. The venture capital timeframes for liquidity, as most people know, that most of these funds are 10-year funds. So you think about a company on average being 15 years when it goes public.
That doesn't work.
You're now running past the VC timeframe. So they've got a liquidity problem as bad as the employees do.
Yeah, I think my first 2 funds that I managed at 500, at least for the first 8 to 10 years, are now 16 and 14 years old. And fortunately, they're both at 3x net DPI, but there's still, some upside that hasn't happened for a few of those companies. So it certainly feels like the majority of the value coming back from VC funds doesn't really happen until at least, 10 to 12 years in. You're sort of lucky if those funds get to 1x. By 8 to 10 years, but a lot of them don't really start returning the big winners until after 10 to 12 years. So I was having this conversation with people the other day where the market used to be sort of before companies go public, that's the venture capital world. And after they go public, that's the retail world. But now there's kind of this middle ground that might be, companies doing 50, 100 million revenue and up. And it might be 5 years or more before they go public. And it's kind of like this middle world. Maybe there's, a couple hundred companies, maybe even, up to 1,000 companies that are in that world that don't really have public company requirements or visibility, but there's certainly a lot of, market value there. Maybe, several $1 trillion, perhaps even up to 5 trillion or more. What's your take on that sort of, middle ground world? This is probably where you guys are playing mostly, I think, right?
Well, it's where we begin to play. And I think the market's going down market. If you look back 10 years ago, when the idea of Forge was being developed, there were really only about 5 or 10 companies that traded in the secondary market. Now there's a couple hundred, but there's probably another 1,000 or 2,000 that aren't trading yet. But back in the 2008 timeframe, they would have all been public, given the size of their revenues and the size of their valuations.
I think that's what's weird, right? Is that these companies that would have been public 5, 10 years ago are going to be private for another 5 years,
It's funny. In another venue I was at, someone was asking me about why those CEOs just don't go public. And my answer was, you know how fun it is to run a private company compared to a public company? I can tell you because I've done both. And
I was going to say, I guess you've had that experience lately.
So as long as you want to be focused on really cool things like building new products and innovating a whole space, being private is great. The second you're public, people want to make sure that your next quarter is predictable, as is your next, 2 years. And so anything that sort of deviates from that predictability, long-term investing being one gigantic example, is a detriment to you as an operator. It's very difficult to manage your shareholders if you're having quarterly board or quarterly earnings meetings and you're not right on plan or beyond plan.
Well, I guess also, it's a combination of the founders wanting to remain private, but also the capital markets giving them the capital to do so.
Correct.
And The canary in the coal mine was perhaps Masayoshi Son and the Vision Fund and somewhat crazy $100 billion fund. I don't know how long ago that was now, probably 7, 8 years ago or something like that. Even though that didn't necessarily go so well the first time around, it seems like a lot of other people picked up that idea and copied it. We obviously had some ups and downs in 2020 and 21 and into 22, but still seems like there is now a really healthy market for secondary activity. Who are your customers? What are their ticket sizes? What are they buying and selling these days?
So we're kind of two businesses in one. There's an institutional business here, which trades in $5 to $100 million tickets. And then there's a retail and high net worth business that trades in $100,000 to $2 million tickets. Part of the beauty of our platform is it sort of matches these two counterparties, and it creates benefits for retail and institutional. There's a little bit different focus there. If you're looking at the really big institutional investors, they're looking beyond the top 20 names down into who are the next generation of top 20 companies. And they're trying to get early into those. Retail does what retail does. It understands that Elon and SpaceX is all over the news. AI is all over the news. They don't know all 19 of those companies I quote. They know 4 of them, maybe 2. And they want to go there. So I think it's a matter of who you're talking to, but it's a market that probably in its totality right now trades about 100 to 150 names, but most of the top 20 to 30 are where the retail are focused.
Got it. I guess we've heard from talking to other folks in the past that, the top 5 to 10 names are half the volume. The top 30, 40 names are 80% of the volume. Is that true for you guys as well, or at least the retail part of your?
That's pretty close. It's pretty close. You get a lot of concentration at the top. It's interesting too, because if you watch the public markets, the Mag 7,
it's kind of the same story.
Is a ton of volume. And, that's one of the reasons why we set out to build some of these fund products, because we thought, man, retail investors should really have some diversification here and not make just one big bet or 2 big bets. That's part of the reasons why we've been tracking these public funds that hold private shares. And we have one of our own that's in the SEC right now.
Okay. Yeah, I was going to ask you, I know there's been a few folks that have come out in that space, and you probably know a few of them from your earlier days. I guess Destiny and Private Shares are 2 of the players, Robinhood, USVC, and now PowerLaw, Ben Black also coming out.
Yeah.
You guys have something in the work. I'm not sure I remember the name, but something to do with unicorns?
Yeah, we announced last year that we were putting a 60 name fund out that was not that was an interval fund. It was not a closed end fund. And it's really important that the world knows the difference, because I'm not sure the world knows the difference. When you're looking at Destiny and Private Shares Fund, both of which were sort of spawned in the predecessor businesses of what is now Forge, these are companies or fund structures that hold a collection of private stock, and these will trade wherever the market wants to take it. So if you've got a lot of speculation, trading those funds is very similar to trading crypto. It's going to run up to 100,000, 120,000. If somebody decides they're going to start selling it, well, it'll drop right back down to $60,000 in a couple of days. That's what a closed-end fund does, holding private shares. If you actually took all the private holdings of those funds and you ran them through Forge Price, which is our proprietary pricing and price discovery tool, you'd find that the delta of value in those holdings and what's being purchased in the public market for those stocks don't add up most of the time. There are big deltas. So what we did is we decided we were going to put out what we called the Forge Liquidity Megacorn Fund. It's in the SEC now, and it is tracking the daily NAV of the top 60 private companies. And that trades based on the movement of that NAV. And so if you want exposure, it's like buying an index or an ETF fund.
So what does it mean if you're picking up a daily price for these companies that are private? I guess that you guys have some information on what those prices are moving around, but generally VCs, they don't reprice on a daily basis. They
Correct.
barely reprice on an annual basis.
So,
Are you looking at trading activity only on your platform or also on other platforms for those
so
prices?
we're looking at everything.
Okay.
We're looking at all the published funding rounds that VCs do, that a company does. In addition, we're looking at what are people trying to buy it for or sell it for right now. These
Yep.
are IOIs. This is the closest to real-time pricing in the private market. So whoever's platform has the most IOIs, and you can bet that if someone's trying to buy something on Forge or sell something on Forge, they're probably over at the other two competitors trying to do the same. When you're looking at those live IOIs, you can see the bid-ask spread, and then you can start tracking what actually closed. What's a closed price look like? When you've got
Okay.
closed prices and those IOIs and funding rounds, and you put it all together, and we've got data scientists here from BlackRock who do this, they'll tell you, here's the closest proximate daily price of pick your favorite unicorn. And when you do that
Okay.
across 60 names and it's weighted by the size of the company, that's the kind of fund that we think, our parents should be investing in if they were going to invest in the
Right.
private markets.
Let's talk a little bit about Forge Marketplace and your primary, sort of business. I guess for folks who want diversification, great to pick a portfolio of, between 20 to 60 companies. But it seems like everybody and their mom wants to be picking stocks these days, both public and private. How does someone, operate on your platform? What do they get to see? What's kind of the background of the companies that you guys are presenting?
Yeah, so we've been, in the last 3 years, rebuilding the entire experience and platform. And in fact, in 2025, that's what we announced in June of 2025, that a new platform experience was being developed so that you could go in, first of all, qualify yourself as an accredited investor, go through the KYC, all the things you need to do, and then start looking at companies. And we're consolidating all publicly available information that we can get on a company. And in certain offerings, the company is providing additional data.
Okay.
And combining that with price discovery, we think starts to make the experience really interesting. So what you're seeing here is pricing history of our derived price over the last time frame for Databricks. And it shows you the different points where the price moved. And if you dig into it, you could start to track, well, where did the funding rounds line up to this?
Okay.
And where did the last trade line up to this graph? And that's the kind of stuff that are more advanced features that give you information that allow you to actually make an informed purchase. So this is still an environment, Dave, where there's not as much information nearly that you could get in the public markets on a company.
I'm assuming you guys are not showing, quarterly financials for the companies, but there might be other news and information about what's been happening, at least with the companies,
Yes, but some companies do start to put out financials before they go public. And if that
Right.
happens, then it'll be there. And some companies will use us to help them manage liquidity. And in those cases, those companies will provide data for visibility by permission only. And so people
Okay.
can subscribe and get a little deeper information from the companies before they make an investment decision.
I was wondering if you could give us a little bit of the blow by blow of, how the company got acquired and what that was like. Obviously, there was a lot of up and downs, over the last 5-6 years. And we went through some crazy times in 20 and 21. It feels like we're going through some crazy times again recently. But there's probably a few rough years in there in,
Yeah.
22, 23, and the SVB collapse happened. And I would guess that a lot of secondary activity was limited during maybe that first year after the downturn in 22.
Yeah, I mean, look, it's like any sort of market cycle. What really was fascinating as I look back on it, and a bit harrowing, was I got to come in and develop this idea for Forge, which was a combination of trading and data and custody, and ride it from 7 million to 125 million in about 6 years. And that was really exciting. That 2021 year, you kind of felt like these valuations aren't going to last. And the unknown was what happens when the market corrects in a big way. And what the data told us, and you'll see this in previously printed reports, is that the overall valuation correction was about 61%, which is astonishing if you think about the public market dropping by 61%. This happened. And what happened behind the scenes at Forge was the sell side supply tripled and got so big that it looked like, oh, we could make a lot of money here. But on the supply side, the sellers decided, no, we're not going to go ahead and the buyers are saying we're not going to pay the price that you want from 2021. Right. And so the market kind of froze from the third quarter of 21 until the first part of 23 with trading volumes dropping because the bid ask spreads were in the 30s, 40% range.
I think we were all wondering what the real price of things are. We also sat on our hands for about 9 months there, trying to figure out what's the right price or discount to buy at. And,
yes, but let me make it even more scary. So in early 23, we had been public for less than a year. I went to the board and said, hey, I need to spend tens of millions of dollars rebuilding a platform. And oh, by the way, our revenue's dropping. And the public markets hated that, of course. So we stuck to it, and the market started to turn in sort of mid 23, and our revenue started going back the other direction. And the platform came out in mid 25. When we went out to the market and started showing what we built, which was a highly scalable environment that could integrate into financial institutions, well, then, big companies started to show up to try and buy Forge. And, the rest is fairly well written about in the public record. But as a public company, when more than 2 or 3 companies show up to buy you, you have to kind of run a process, and the outcome is dictated by who's done their work and really, really sees the vision as part of their vision. And that was Chuck Schwab and the team over there. And they'd been watching us for a couple of years and said, wow, we really love what you're doing. And let's try and go make it happen together.
Do you feel like you guys have a larger mandate now that you're part of Schwab? And, what is, your offering relative to competition out there? How do you guys, sort of position yourself?
Yeah. So I think there's 2 answers. One is both in the cases of Schwab and Morgan Stanley, they've been watching the market or participating in it for the last few years. So they really understood where the puck was going. I'd say the real question is, Schwab is a very focused company based on the wealth business. They're not investment bankers. They're very focused on taking care of the 46, 48 million clients that they've got as investors. I'd say the recognition was, if we're going to go scale this and distribute it, which is what the big guys want to do, who has built scalable tech? Who has built something that looks like where the market's going? And I'd say only Forge and Equities End really check that box. And even then, there are some questions about how modern is the tech, and can it withstand what happens when in 2027 people open up their apps at Morgan Stanley or Schwab and try and trade a private share. So that's really an acceleration of the vision of the company. In fact, in 2019, in one of our offsites at Forge, I said, hey, at some point, if our vision is realized and we start to democratize it, we'll look like the Schwab of the private markets. And so that was without a sense of irony what happened. But I'd say scalability, distribution, and an experience that's meant to serve both the companies, because look, the source of all this secondary activity starts with the companies and takes care of the investors at the same time.
It certainly seems for AI companies, for space companies, for defense tech companies, it's been a lot of attention in the last year, and probably 20 names, maybe 30 names in those categories that have been rising fast and quick. We can maybe throw in prediction markets and a few other, robotics companies in there as well. How do you guys, provide insights into those companies? Are you just letting the market sort of decide where those companies are priced? How do you prepare, buyers and sellers, I guess, for what the right price is to buy and sell their positions?
So our Forge price is now used by Yahoo Finance, CNBC, Fortune. A number of players use it. I think our view is we're not in business to tell people what to invest in, and we're really not recommending any stocks at all. But what we are doing is saying, do the work. We're going to provide you all the publicly available information we can that's out there. We're going to provide you proprietary data and price discovery information, and then you just have to decide. But the truth is, and particularly at the very top of the market with SpaceX doing something that we've not seen before in terms of size of an IPO, the way it was distributed. I mean, there's a whole bunch of first times with SpaceX, that people are going to make their decisions and the market will ultimately adjust to how that plays out. And, the $125 share price when it came out, we were oversubscribed to get into this, and there wasn't enough to go around. That was one of the major themes of the IPO that SpaceX, orchestrated. But now the market's starting to settle in. You're going to see, their first public disclosures, and you're also going to see some of these lockups come off. And that's going to
be a lot more float happening in another week or so.
So that'll essentially show us for the first time what happens when something of this size comes out. And there was a bunch of people that held the stock. I mean, over a decade or more of pretty active buying of SpaceX across the world is going to show us, and we'll learn from it.
I don't know if you can comment on Anthropic and OpenAI, but those are probably the next two gigantic IPOs that are on the horizon. Certainly Anthropic seems likely. I guess we'll find out about OpenAI, but any lessons learned from what's happened with SpaceX? And do you feel like maybe SpaceX was a little too aggressive about setting price, maybe a little too tight on the amount of float that they let out the door?
I was a little surprised at the amount of float, but I also think that Elon's got a long-term vision that a lot of people want to be a part of.
A long-term vision.
I mean, so the SpaceX use case is sort of a different example than OpenAI and Anthropic, but I think you just have to watch it play out, because he's playing several hands ahead, and there's a ton of people that want to make a 10-year bet on Elon. I heard a bunch of them on my platform over the last 6 months. So I think that one is almost unique. When I think about OpenAI and Anthropic, they're also unique in a very different way, which is they got very big very quickly. And the kind of numbers they're putting up in terms of revenue,
really astonishing,
year over year, has never been seen before. I mean, I've never seen this before. I said this on CNBC a while back, where I said, hey, look, these companies are growing 300% or more a year on big numbers. So what's that valued at? I don't know. But what I also know, Dave, is that when companies get that big, that fast, everybody in the world wants to buy it. And it becomes very hard. And that was part of what you saw with some of the restrictions that they came out with. They wanted to send a message, kind of a warning shot, don't trade this stock. And the truth is, in the market that's coming, this is part of what Forge is built for. Hey, let's help people buy stocks. But there's also some restrictions in some of these stocks where they don't want them to trade. So if you're going to buy something, you're going to be restricted in trying to sell it or offer it to your friends or do anything that violates any restrictions. So I think those two examples were cases where the company got so big and valuable that the whole world wanted to invest, and it becomes an almost irresistible force to try to control.
Right. Well, I think, it's interesting because those companies both have revenue, in the tens of billions of dollars. Some people are speculating that Anthropic might be doing 100 billion by the end of the year. It sounds like At least OpenAI is in the 40, $50 billion a year range. These are huge numbers for private companies in particular, but they'd be huge numbers even for public companies. I guess once we get past, these big three, SpaceX, OpenAI, and Anthropic, what's next on the horizon, and where do you see this going over the next couple of years? I don't think we're going to see trillion-dollar companies going public every year. Even $100 billion private companies maybe is rarefied air, except for maybe 5 to 10 companies. Seems like the more typical size is going to be in the, let's say $1 to, $25 billion, market cap.
I think it's going to be a little higher. I think it's going to be a little higher than that. I think it's probably going to be more like 10 to 50 billion.
Okay.
Just because I think there's so many incentives to stay private as a $1 billion company that it just, and plus the public markets don't pay a lot of attention to the smaller cap guys, particularly if they're still investing. But I'd say, there are still probably a dozen companies that are lined up, maybe 20, that are probably in that 20 to $50 billion range. The prediction market stuff, I mean, Kalshi's been on fire. You've got the whole defense sector led by Anduril and others.
And Saronic. And I think we're going to be previewing Helsing, which is the European defense tech company, in this episode. Later.
I think you're going to see a whole bunch of really interesting applied AI companies start to come out too, that are using AI in different ways. So I think we are going to see almost not a golden age, a resurgence of really great IPOs. But I think we're also going to see the extended time of companies continuing to stay private longer. Yeah. And so part of what we're focused on is how do we get VCs liquid too? Because VC funds need to get liquid. And I got to tell you,
absolutely.
I'm convinced
DPI
that
is the abbreviation of the day. Yeah, for sure. Are you guys working with VCs on their portfolios? Is that also a customer for you guys?
But the venture capital community has been a customer of ours for a decade. So it's been really selective. I envision a world where you have more programmatic liquidity through VCs. And part of what we're trying to build at Schwab is reliable, safe, and regulated infrastructure that allows liquidity, whether you're a company with employees or a VC fund who have LPs that are tied up for 20 years. Your LPs want to trade some of those positions. And guess what? Those trades that are happening through LPs in their VC funds, that should be part of the VC's business model.
I think you're right. Well, you're getting into our business as well. We do direct secondaries in companies, but we also do LP secondaries and even GP interest in funds. And that's a more complex and a little bit more obscure market. But I wonder if you have any advice for, I guess, both VCs and startup employees that are looking for liquidity. I think we're seeing a lot more company tender offers, organized, tender offers now. I believe if I look at Carter's numbers, they said there was something on the order of maybe close to 400 organized company tenders last year. I think they're predicting that they'll, be 500 plus next year. Now, obviously, a lot of that's concentrated in the big names, but there's probably a bunch of companies there that are, doing tender offers, maybe $25 to $100 million worth of tender for a company that's a, $2 to $5 billion, maybe up to $10 billion market cap. Do you see that being a growing business as well? And is that, I think you guys do some company tenders as well as direct stocks, right?
Yeah. So I think it is a business model that is going to change dramatically in the next 2 years. I think that tenders are going to get really inexpensive. And I think the pricing of a tender is going to be very closely tracked to some of the data that's out there in the market now. And I think if you just look back 4 or 5 years ago, tenders were primarily being done from an inside round. An existing investor buys back stock at a discount, and then people get to participate. And what I've said all along is that whatever that tender price is, it better be matched with what the prevailing price in the market is, which is a concept that hasn't existed in the private markets. The prevailing price has been the last round of preferred. So I think
stale price from a year ago or 2 years ago.
Right. That's right. So what I think you're going to see is a more dynamic pricing approach to tenders, where they're going to be priced at a certain point relative to the market and on market, and they're going to be done more frequently and with automated scaled systems that allow a level of participation that doesn't risk some of the protections that companies need. They need to have transfer restrictions. They need to see controls over who gets the stock, whether you're an SPV structure or you're on cap table. But I think they will continue to evolve, Dave, in the world of secondary trading, and tenders are coming together rapidly and will be here in the next 12 to 24 months.
I guess over that next, 3-year horizon, any big predictions, things you see that are happening that other people haven't quite, glimpsed yet? If you have any crazy predictions or conspiracy theories, we always love to have a big, bold statement at the end of the interview.
Oh, okay. Well, no, I just think you're going to see this secondary market at scale, and you're going to see a much more accepted and standardized set of ways to participate in it. And I think it's like anything else. You're going to see consolidation into a small number of trusted places. Right now, this market, at least up to now, has been fueled by a lot of people wanting to get into it and a lot of opaque information and lots and lots of participants, and you don't know who you're dealing with, and it's 3 layers of SPVs. I think that's going to get cleaned up. And it's
I
going to
feel
get
like
cleaned
we're
up
buying tickets at a Lady Gaga concert that have exchanged hands 3 times. And
That's right.
The markup happens each time, and you're not even sure if those tickets will get you in the door.
And you're going to see some normalization of fees too, because there's some fee nightmare stories out there in the world. And that's gonna come to an end. So probably not as dramatic, but definitely the maturing of the private market.
Well, Kelly, thanks for spending some time with us, and good luck running Forge. And hopefully the parent company Schwab gives you guys a much broader audience to go after going forward too.
Thank you, Dave. It's great to talk to you.
This week, Professor Aman Verjee is going to be covering Helsing, a European defense tech company. Aman, what's Helsing do?
Indeed, they are a German defense tech company. So last week we covered the sector more broadly. This week I just want to go deep on one of the players. The Helsing is located in Munich. They are the developer of an AI-driven autonomous systems and defense hardware system. They are selling primarily to NATO and NATO-aligned countries, and just announced an $18 billion valuation earlier this month. So they just completed it. It's a $1.8 billion round, just led by Dragoneer and Lightspeed. And they were inspired by Karl von Clausewitz, the Prussian general, maybe the most famous strategist of all time. If you go to West Point or really any military school, you're probably going to read about von Clausewitz. So, I thought I would honor him today with Helsing. Von Clausewitz is not on the management team of Helsing, but this is the management team. The founder and CEO is Dr. Gunbert Scherf. He describes himself on his website as a staunch European, which strikes me as an interesting way to describe yourself on a website. But I think there's actually a point to it, which I'll get to in a second. The team in general is actually very strong, led by their CEO. But you can see here the key players on the team. Their co-CEO is Torsten Ryle. He's come from Zynga. They've got folks from Palantir, like Sam Rogerson, who's their COO, and Robert Fink. Dr. Scherf himself is from McKinsey and Company. Always a good sign. We have a former McKinsey partner at the top of the pyramid, and then lots of talent from big European companies that have been built and scaled before. So overall, I think a very strong management team. The thing to remember with this company, because they are a defense tech company coming out of Europe, they are considered, I think, now the champion with this latest round and their revenue scale. They seem to be the biggest defense tech company in Europe. And there's going to be a natural inclination to want to support companies in Europe where the technology works, where you have a expanding set of defense budgets now in Europe, and a perception, rightly or wrongly, that the U.S. is stepping away from playing the policeman or protector of Europe. And threats like Russia in their eastern front are things that Europe's going to have to deal with themselves. So I think those are good reasons to invest in the company and why they seem to be well positioned in the current space. The things to worry about, they're still very, very young, still scaling. Valuation, we'll talk about in a second, that seems to be a concern. They are very dependent on defense primes to build the hardware. They don't really build the hardware. They are a software company. I want to talk about the TAM, but as a negative. So there are expanding budgets on the one hand, but they're really only selling to Europe on the other hand. So let's just go through, some of those. Let's talk about their financing and investment. So this is the list of U.S. companies that we've covered last week in Helsing. And let's just look at where they've gotten their VC backing. So in the case of the American companies, you can see they've gotten some very strong VC backing from sponsors early in, like Founders Fund and 8VC, and recent some investing across the board in Anduril, Shield, and Saronic. And then Lux Capital has been involved in a couple of these companies. They've gotten some very important scale capital from folks like General Catalyst and Point72, and really now A-plus partners later in the game. So whether it's Founders Fund, Kleiner Perkins, General Catalyst, Fidelity, very strong VC funding from all these companies. Helsing really hasn't had that same track record until fairly recently. They had their early capital from General Catalyst, but also Saab, you wouldn't think as a natural for the space, more of a strategic. And then this is Daniel X Fund, Prima Materia. And then they have now Dragoneer and Lightspeed. So only recently have they gotten into the A-plus VC game, but they've gotten there with Dragoneer and Lightspeed. So I guess that's the good news. Valuation, a bit of a concern, I think, with Helsing. They just did the round at a 32 times estimated ARR multiple. Compare that to Anduril, who is like a 13 to 16 times multiple. Anduril's got about 4 billion plus in revenue, did the last round at 61 billion. And Helsing is just over 500 million in revenue, scaling pretty quickly, but still a premium valuation. So the valuation is another concern you'd have with investing in this company. The third concern, just to think about, is the defense budgets and where the defense budgets are. This is a map of where the defense spending is. You can see that about a third of the defense spending in the world right now is coming out of the U.S. We've got also China and Russia, that are not democratic countries. By policy, Helsing does not sell into those countries. Where are they selling to? It's basically Germany, France, Ukraine, maybe Italy. They're working on some contracts with the U.S., but haven't really locked them up yet. So when you're selling into the space, one thing to think about is, well, if you're not selling to the U.S., which is the third or 40% of the global defense market, how big a business can you build, and what does the TAM look like? I think it'd be great if Helsing can get more traction with the U.S. Defense Department, which right now is primarily giving money to Anduril and Saronic and Shield. So that's the other concern to think about with Helsing. Lastly, just go into a comparison between Anduril and Helsing. Here's some puts and takes and pluses and minuses. What I do like about Helsing is they are primarily software. They have a very, very strong autonomous mesh AI-driven backbone. It's probably as good as Lattice, which is Anduril's flagship. So you have an excellent technology that works. Their hardware is the challenge. They don't really have the same kind of hardware that Anduril has. Anduril is an Adams. They do hardware, they do software, it's all integrated. It all works together. Helsing is more of an asset-light model, and they're outsourcing a lot of this stuff to primes. So that's the downside, I think, where they might have a challenge. On the other side, they've got better gross margins because software is going to have 65 to 70% gross margins. I think Anduril is going to be in the 35 to 40% range. So they get a plus on the financials. They probably get a draw on the software, maybe a minus on the hardware. But they are also battle tested. Their stuff has been going through battlefield trials in Ukraine. So as far as resilience and dealing with GPS denied navigation, in real environments, they've done it, and so that's a big plus, and I think a big reason why they're able to get the round done. So overall, I would say this is at $18 billion. The valuation is a little bit on the high side. The fact that Dragoneer and Lightspeed are leading is a really big plus because they are battle tested and have a great software system. I think that's another really, really big plus in the technology with a good team. The valuation might be a little bit rich if I had to pay for them at 32x versus Anduril at 13 to 20 times. I think I might tip towards Anduril because they've got the scale and the bigger defense budget to sell into the U.S. The thing I'd really watch for in the next couple of months, though, is if Helsing can sell into the U.S. DoD with contracts, that probably doubles their TAM, and then I think it's off to the races for for Helsing.
Well, thanks a lot for that coverage, Aman.
All right. Thank you, Dave.